So last Thursday, something interesting happened in the market. The 10-year bond yield for both Canadian bonds and US bonds have hit their record high since February 2020 at 1.468 and 1.61% respectively. Now, even though it has retreated on Friday, the spike was enough to trigger a sell-off in the market and also pressure the bank to increase the 5-year fixed mortgage rates. Now, a lot of people are wondering, what does this mean? So in this video, we're going to go into talking about what happened to the bond yield and what does it mean for investing in the economy, also what kind of impact we might see in the housing market, and finally, we'll wrap up by talking about what are some things you need to pay attention to as we move forward. So without further ado, let's jump into today's video. Alright, so first let's start talking about what is bond yield and what happened to it. Now, for people that don't know, basically when we talk about bonds, it's essentially a loan that you lend to someone else. So if it's a corporate bond, then you have lent your money to a corporation in exchange for a bond, like an IOU. And if it's a government bond, then you have lent your money to the government. Now, we're not going to go into different types of bond. It's too complicated for this topic. But essentially, when you lend something to someone, you expect to earn an interest on it. And that is essentially what bond yield is. It's how much return you can expect by holding onto this bond, by lending your money to whoever you're about to lend to. So bonds are regarded to be the complete opposite of stocks. It is extremely safe. It's basically like a GIC where you know for sure how much interest you're going to get on the bond that you're about to buy. Now, because of COVID last year, basically all governments around the world have cut their interest rate to stimulate more borrowing and economic activities. So obviously, when interest rates are slashed, bond yield also dropped. And it has dropped back to a record low in order to encourage more people to take more risk if they want to get return in their investments. But recent months of how much positive news there is about the vaccine and also the rollout plan and the speed, especially in the US, we're up to 1 million doses a day. They really are looking to vaccinate everyone before July 4th. And also, because of a new president, there are more expectation for a bigger and more stimulus going into the economy. This has really pushed some of the investors out of the bond market into riskier assets like stocks. So hopeful for future economic growth pushes up the bond yield. Now, what does this mean when it comes to investing or the economy? So when bond yield is low, people are not making much. They go into stocks trying to get more growth there. But on the other hand, when bond yield jumps, now it's more attractive for investors to store money in the bonds. So this has caused people to sell off some of their stocks, especially tech stocks, because number one, they're not as attractive anymore. When bond yield is up, there's a better, potentially more incentive to jump over there. And although is people think that after stimulus is gone, after people are made a full recovery after COVID, tech stocks, especially the growth tech stocks like Netflix, Facebook, Google, etc., are not going to be as valuable as before when everyone is locked down and working from home. So this is why on Thursday, there's a mass sell-off of the tech stocks, especially high-growth tech stocks. Whereas on the other hand, companies who have suffered during the COVID time or perceived to be able to do better after COVID is gone, like bank stocks, had a much better return on Thursday. Now, in addition, some people have argued that a higher yield also signals potential inflation spike around the corner. Now, this is not something definite, so we have two sides of the party arguing. One side that is more bullish have argued that this doesn't really mean actual inflation is coming. It's more about perceived inflation. So people are getting scared and being worried about inflation when there is no such spike that will be happening. Where on the other hand, obviously they would say this is a clear evidence of inflation coming. But the reality is, when it comes to commodity price, we are seeing inflation. For example, copper has gone up. Oil prices has gone up. However, on the consumer staple side, the actual things that people buy every day, we haven't seen too crazy of an inflation. It's keeping steady. But if commodity price go up, likely these kind of inflation is going to transfer over. So that's something that, we're not sure at the moment, but something we have to keep in mind moving forward. So because of the talk of inflation, this also have people speculating that potentially governments have to increase the interest rate soon in order to combat the inflation. So usually when inflation is starting to go up, this is what government will do to combat the inflation. They're gonna use their monetary policy, such as things like increasing interest rate, to try to discourage as much borrowing as before to really calm down the money flow in the market. However, last week, the US Fed Chair Jerome Powell have downplayed the inflation concern and reassured people that the central bank see no reason to alter its ultra low rate for foreseeable future. So at this moment, at least, it seems like the government is not too concerned about the inflation issue and they're determined to keep the interest rate low in order to have as much money circulating the economy as possible for a much quicker recovery. Now, if we talk about the recent market drop and the yield, it does seem like rising yield is bad for stocks. However, actually historical data shows otherwise. According to data from Truist Advisory Services, S&P 500 has an average annualized return of 13% and has increased 81% of the time during rising rate period, which is 13 of 16 of the periods. So while a rising yield can introduce more sell-off opportunity and also introduce volatility into the market, it does not necessarily mean it's a definite long-term drop. However, an increasing bond yield does affect some of the mortgage rates, so let's talk more about that. Now, a quick reminder before we move on that we have a private group on Facebook where you can request to join, ask questions, and get more content in the future. So link is in the description below. And also we have a second channel that just launched talking about business ideas and what we have learned for the last couple of years building from nothing to a deep six-figure business system. So if you're looking to start your own business or side hustle, make sure you check out that new second channel. So while the bond yield in US is rising, the similar story is also happening in Canada. Bank of Canada's 5-year bond yield have also shot up last week. Now, what that does is actually reduces the spread that mortgage lenders can earn on their mortgage, so they will be forced to increase their fixed mortgage rate in order to still maintain the spread. Now, TD was the first bank that actually hiked their 5-year mortgage rates. They've increased the rate by 0.25% to 2.24%, which is the highest it has been since September. This move is expected to be followed by all other major banks very shortly. Now, in one of the articles I've been reading, Globe and Mail have some good tips for current mortgage shoppers. So if you're shopping for a mortgage, you're house hunting right now, some of these tips might be for you. Number one, if your house is completing in the next 4 months and you're looking for a fixed mortgage and you don't have a pre-approval or a rate lock that's done, get one over the next couple of days as soon as possible. So talk to your mortgage broker or talk to your lender to get a rate lock. Now, number two is when you do a pre-approval, the rates are rarely going to beat the actual live rate, but it's still good to lock it in because a possible increase is coming. So in case the actual live rate actually goes higher than your pre-approval rate, it's good to lock one in right now. Now, number three is also something I've talked about all the time, is pay attention to other features when it comes to your mortgage. Don't just pay attention to the interest rate. You want to look at things like prepayment penalties, time to port your mortgage if you have to port it to another house because you are changing houses, and other limitations. Rate is important, but it should not be the only thing you look at unless you're 100% sure you're staying at the same place and you're only paying minimum or within the prepayment penalty for the next 5 years. Or else you might find yourself to get stuck with a huge penalty if something else comes up and you really need to make a change to your mortgage. So pay attention to those things. Number four, make sure you get a validation from your broker or your lender that your rates are actually guaranteed. It is not guaranteed just because they tell you verbally. They actually have to guarantee it by submitting your app to the bank. So whoever you're going with, make sure the app is actually submitted to the lender. Now, lastly, in the article, it says if you're refinancing on a closed fixed mortgage, get a rate lock, but don't close on it too fast. Because if the short-term interest rate does increase next month, your penalty could be significantly lower than what you have to pay currently. Now, lastly, when it comes to interest rate and also bond yield, etc., my advice and also an advice in the Globe and Mail article which talk about this is don't trust Bank of Canada too much. Even though they said before they have intended to keep the rate low for foreseeable future, at the end of the day, these are just verbal messages. They could change on a dime depending on what the bond yield is doing. Now, government does have the option to cap the bond yields to maintain it from going too high, but it's very rare they do something like this because it will introduce other very bad consequences or even more inflation down the road. So even though they have tools to handle things like this, unlikely they will use it. And so what that means is bond yield, if it really does jump too high, while they're saying that they're not going to increase interest rate, they might be forced to do so. So lastly, let's talk a little bit more about what does it mean for the housing market. Now, in the previous video, we all know the housing market is very, very hot right now. And I've said that if you want price to drop, you have to increase interest rate. This is the one big thing, the main thing that has to increase before you have a chance to see any big drop in the housing market. However, a recent 0.25% increase in the mortgage rate will not put much dent onto the market. In fact, I would imagine it has almost no effect at all. Even if we take a 500k mortgage, a 0.25% really means nothing when it comes to their mortgage monthly payments. And also, the current increase in rate is just the fixed rate, so the variable rate is not increasing. Now, the following is not research in any way, it's just my perception. But because right now the 0.25% is only on fixed rate and not variable rate, so after the rate increase, what might happen is people might look at the difference in the variable rate and the fixed rate, and they will just choose to go with a variable rate instead. So before, if they're thinking about locking something in after rate increase, they might just be more tempted to go variable rate. And while it doesn't affect the mortgage approval amount in total, what that might do is actually once they go variable, their payment is actually lower because of a lower rate. It might tempt some people to borrow more towards their maximum because now they perceive this as a cheaper borrowing cost. So if you're someone that decided to change from a fixed rate going to a variable rate for a new home right now, make sure you don't get tempted because you see a lower payment and it makes you think you can borrow more towards your maximum. Because like I said before, prime rate can change as well, and if it does, you borrow too much, you might make yourself feel squeezed. Now, I was reading articles, a mortgage broker called Ron Butler also commented that they don't expect to see an immediate impact from bond yield climbing. Last time in 2018, they didn't see any clear reduction of activities until 5 years rate went over 3%. So like I said before, 0.25%, I really don't think it's going to make too much of a difference. However, we have to pay attention to the bond yield because if it keeps going up, then the fixed rate can get more and more expensive. And then eventually that might really push Bank of Canada to increase the prime and make variable rate increase as well. So if Bank of Canada does increase rate, then rental return is going to drop because the cost is going up while rent can be increased because you signed a contract already. So we might see a landlord feel more squeezed. And when that happens, that's when we really will see a reduction in activities in the real estate market. So if you have investment homes or you just recently bought a home, then you really want to revisit your budget a little bit more to account for potential further increase of interest rate. Alright, so what do you think about the bond yield problem and the interest rate issue? Do you think it's just a blip? It's just something that happens this week? Or is this going to be an ongoing problem that we have to pay attention to? Let me know in the comment below. Now, if you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you comment, like, and subscribe to the channel. Click the bell button so you get all the notification in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye.